the federal government collected a staggering $4.4 trillion. This system originally impacted only the top 1% instead of every single American worker. But history hides the fact that this temporary revenue solution, when the 16th Amendment passed in 1913, Congress promised that 99% of the population would keep every penny. We are pulling back the curtain on how a surgical strike against the elite transformed into the largest permanent expense of your life. Imagine a world where your paycheck was yours to keep in its entirety, with zero federal withholding line items eating away at your hard-earned cash. Before 1913, this wasn't a distant dream, it was the American reality. Back then, the federal government didn't look at your bank account, it looked at the shipping docks. Approximately 90% of federal revenue came from customs duties and excise taxes on specific goods like tobacco and liquor. If you weren't buying imported finery or heavy spirits, you barely felt the weight of Washington in your wallet. But everything shifted with the ratification of the 16th Amendment and the subsequent Revenue Act of 1913, signed into law by President Woodrow Wilson as part of his new freedom platform. This legislative pivot, spearheaded by figures like Oscar Underwood and Cordell, was marketed as a progressive triumph that would finally force Gilded Age tycoons to pay based on their ability to pay. The initial numbers were almost laughable by today's standards, a base normal tax of just 1% on net income. Even more striking was the personal exemption. In 1913, individuals were exempt on the first $3,000 of income, while married couples were exempt on the first $4,000. To put that in perspective, $3,000 in 1913 had the purchasing power of approximately $95,000 in 2024 dollars. This meant the tax was surgically designed to exclude the vast majority of wage earners. In its first year, less than 1% of the U.S. population paid any income tax at all, and the government collected a relatively modest $28 million. It was pitched as a small elite levy intended to offset revenue lost from lowering high tariffs. However, as any economist will tell you, there is nothing so permanent as a temporary government program. What began as a 1% contribution from the ultra-wealthy has evolved into a complex, nearly inescapable system that now claims a massive portion of the average worker's productive life. To understand how we ended up with the Internal Revenue Service effectively sitting at your kitchen table every April, we have to look back at an American landscape that would be unrecognizable today. For more than a century, the federal government functioned like a distant landlord rather than a business partner. Before 1913, if you worked a full week in a factory or on a farm, you took home every single penny of your wages. There was no line item for federal withholding. Instead, the government ran on what we call indirect taxes, specifically customs duties and tariffs. Think of these like a massive markup on imported goods. If a merchant brought silk from France or steel from England, they paid a fee at the border. By the early 1900s, approximately 90% of federal revenue was generated this way, alongside excise taxes on vices like liquor and tobacco. It was a system where you only paid the government when you spent your money, never when you earned it. But by the dawn of the 20th century, the progressive era was in full swing, and the economic mood was shifting. The Gilded Age had concentrated enormous wealth in the hands of a few industrial titans, while high tariffs, which protected domestic industries, were driving up the cost of basic goods for everyone else. This created a political pressure cooker. Enter Woodrow Wilson and his new freedom platform. Wilson, along with tactical masterminds like House Majority Leader Oscar Underwood and Representative Cordell, frequently called the father of the income tax, orchestrated a bold restructuring of the American economy. Their goal was the Revenue Act of 1913, also known as the Underwood-Simmons Act. The logic was simple and, to many at the time, quite seductive. Lower those tariffs that were making life expensive for the average family and fill the budget hole by taxing the ability to pay of the super wealthy. The move was even supported by Wilson's predecessor, William Howard Taft, who had proposed the 16th Amendment years earlier in 1909 as a strategic compromise to appease populist anger. When the Revenue Act was finally signed into law on October 3, 1913, it was sold to the public as a targeted strike against inequality. The initial rates were almost laughably low compared to modern standards. There was a personal exemption of $3,000 for individuals, which carries the purchasing power of roughly $95,000 in today's economy, meaning the tax didn't touch the vast majority of wage earners. In fact, less than 1% of the entire U.S. population paid any income tax at all in 1914. The normal tax was only 1% on net income, and the absolute maximum surtax for those making over $500. It was a surgical elite levy designed to fund a lean government. However, by creating a direct pipeline from the citizen's pocket to the federal treasury, Wilson and Hull hadn't just solved a revenue problem, they had built the infrastructure for a permanent expansion of state power that few at the time truly anticipated. To understand how the federal government managed to get its hands on your paycheck, we have to look at the massive legal roadblock that almost killed the— Think of the U.S. Constitution as the ultimate terms of service agreement. For over a century, that agreement strictly forbade the government from taxing you directly unless they followed a very specific and nearly impossible rule called apportionment. Essentially, if the government wanted to raise money through a direct tax, they had to divide the bill among the states based strictly on their population, not on how much money the citizens actually made. This meant a poor farmer in a high-population state could end up paying more than a millionaire in a low-population state. It was a logistical nightmare and a political non-starter. The drama reached a boiling point in 1894 when Congress passed the Wilson-Gorman Tariff Act, which included a modest 2% tax on incomes over $4,000. In today's terms, that $4,000 threshold was roughly equivalent to $145,000, meaning it was strictly targeting the Gilded Age elite. However, the wealthy didn't take this sitting down. The case of Pollock versus Farmers Loan and Trust Company landed before the Supreme Court in 1895. Chief Justice Melville Fuller delivered a hammer blow to the progressive movement, ruling that the income tax was a direct tax that violated the apportionment clause. For nearly 2 decades, this decision acted as a legal shield for the ultra-wealthy, ensuring that 90% of federal revenue continued to come from tariffs and excise taxes on things like liquor and tobacco, consumption taxes that hit the working class the hardest. But the pressure of the progressive era was becoming an irresistible force. By 1909, the insurgent Republicans and Democrats were clamoring for a way to break the monopoly of the robber barons. President William Howard Taft, though a conservative-leaning Republican, saw the writing on the wall. To prevent a more radical tax law from being passed immediately, he proposed a strategic compromise, a constitutional amendment. This was the ultimate bypass. If the Supreme Court said the law was unconstitutional, they would simply change the Constitution itself. Senator Nelson W. Aldrich, a powerful conservative who loathed the idea of an income tax, actually supported sending the amendment to the states, betting that it would never be ratified. It was a massive miscalculation. He underestimated the growing resentment toward the extreme wealth inequality of the era. The battle moved from the halls of D.C. to state legislatures across the country. For nearly 4 years, the 16th Amendment hung in the balance. Finally, on February 3, 1913, Wyoming became the 36th state to ratify the amendment, providing the 3/4 majority required to change the supreme law of the land. Secretary of State Philander Knox certified the result on February with 42 simple words. The 16th Amendment gave Congress the power to lay and collect taxes on incomes from whatever source derived, without any requirement for apportionment among the states. The legal shield was gone. The Supreme Court was bypassed. The architecture for the modern American middle-class tax burden was officially complete, turning the federal government into the primary partner in your personal earnings. The promise made by Woodrow Wilson and his progressive-era allies in 1913 was remarkably simple: a tiny 1% tax on net income that would only ever touch the ultra-wealthy. But as any student of history knows, once the gates of taxation are opened, they are rarely closed. This is what economists define as mission creep, the process where a temporary targeted measure slowly expands until it becomes a permanent and all-encompassing foundation of the state. The primary catalyst for this massive transformation was the arrival of global conflict. When World War I began, the federal government realized that the luxury tax model designed by Cordell and Oscar Underwood was no longer sufficient to fund the rapid assembly of a modern military-industrial complex. By the time the United States fully committed to the war effort with the War Revenue Act of 1917, the financial landscape of the nation was altered beyond recognition. In just 5 years, the top marginal tax rate, the rate applied to the highest bracket of income, exploded from that initial 7% in 1913 to a staggering 77% by 1918. To put that in perspective, if you were a top earner, the government portion of your income increased more than tenfold in the time it takes to finish a college degree. This spike was not a one-time anomaly. It set a new precedent for the limits of federal power. While rates cooled slightly during the 1920s, the economic trauma of the Great Depression and the existential threat of World War II provided the moral and political justification to move the tax from the peaks of high society into the paychecks of the common worker. The most radical shift occurred with the Current Tax Payment Act of 1943. Before this legislation, the income tax was a class tax. You were responsible for calculating what you owed at the end of the year and writing a check to the government. It was a conscious, painful, and very visible transaction. However, in 1943, to ensure a steady and reliable stream of cash for the war effort, the government introduced mandatory withholding, the process where the government takes its portion before your paycheck even hits your bank account. For the first time, your employer effectively became an unpaid tax collector for the federal government. What started as a tiny luxury tax was about to become a massive permanent burden. This shift made the tax invisible. It functioned exactly like a mandatory subscription service that you are legally prohibited from canceling. By taking the money at the source, the government reduced the psychological friction of the tax, making it much easier to raise rates without triggering a mass revolt. The numbers from the 1940s. By 1944, the top marginal tax rate peaked at 94% on income exceeding $200,000. While most workers were not paying that top rate, the mass tax had officially arrived. By 1950, income tax accounted for over 50% of total federal revenue, a status it has maintained for over 70 years. The 1913 revolution was now complete. What was originally sold as a targeted solution to wealth inequality had, through the vehicle of war and administrative strategy, become an inescapable financial reality. The temporary measure of 1913 had become the single largest permanent expense in the American household, often dwarfing the combined costs of food, clothing, and transportation. This is the mechanism that transformed the American economic engine, turning a government once funded by global trade into one funded by the day-to-day labor of its own citizens. Progressively, the definition of wealthy was lowered, and the definition of temporary was forgotten, leaving 21st century workers to foot a bill their ancestors were promised they would never see. Everything we have discussed leads to a singular, uncomfortable realization. The modern tax code is no longer just about revenue. It is about control and social engineering. What Woodrow Wilson, the scholar president with his sharp features and academic pince-nez glasses, and Cordell Hull, the lean Tennessean, known as the father of the income tax, envisioned in 1913 as a surgical strike against the idle rich, has mutated into a 70,000-page leviathan. This administrative monster dictates how you invest, where you live, and how you plan for your children's future. It is a system where the original 4-page Form 1040, a document so simple it could be completed on a starch-collared gentleman's kitchen table in 20 minutes, has been replaced by a bureaucratic labyrinth that consumes billions of hours in American productivity every single year. Consider the math of the progressive era versus your modern reality. In 1913, that $3,000 personal exemption set the bar so high that roughly 99% of the population paid zero federal income tax. Today, that same $3,000 adjusted for inflation has the purchasing power of approximately $95,000. If the 1913 standards and thresholds were applied to our current economy, the vast majority of people watching this video would not owe a single penny to the IRS. But while the tax rates themselves have fluctuated wildly, peaking at a staggering 94% during the height of World War II, the most profound shift occurred in how the government actually accesses your wallet. After the current Tax Payment Act of 1943, the income tax transformed from an annual elite bill into a per-paycheck mass deduction through mandatory withholding. This was the ultimate psychological victory for the federal government. By taking the money before it ever even hits your bank account, they turned your largest single expense into an invisible abstraction. Much like a Netflix subscription you forgot to cancel, you don't feel the sting of the loss of $500 every week the same way you would feel writing a manual check for $26,000 every single April. To break this system in the 21st century, you must stop being a voluntary participant. You have to move your capital from tax-vulnerable environments to tax-advantaged ones. This begins with understanding that the massive tax code is not actually a list of rules to punish you, but a map of incentives. The government wants you to provide housing, so they offer massive breaks for real estate owners. They want you to fund the industrial engine, so they offer 401k and IRA vehicles. To reclaim your wealth and navigate this fiscal reality, your first actionable step today is to perform a personal fiscal audit. Do not look at your tax refund as a yearly bonus. A refund is simply proof that you gave the government an interest-free loan for 12 months, while your own credit card or mortgage debts were likely accruing interest. Instead, pull up your most recent pay stub and calculate your true effective tax rate. Add up your federal, state, and payroll taxes, then divide that total by your gross pay. If that number is higher than 20 or 25%, you are effectively working for the state until the middle of every work week. Once you have identified your true number, find one specific above-the-line deduction, such as an HSA contribution, a traditional IRA deposit, or a contribution to a 401k, to lower your taxable income by just $1,000 this year. That small adjustment, if done consistently and compounded over decades, can shift hundreds of thousands of dollars from the federal treasury back into your family's multi-generational legacy. We are living in the shadow of the 1913 revolution. But if you want to master the hidden mechanics of the global economy and learn how to keep more of what you earn, hit the subscribe button and join us as we deconstruct the systems designed to keep you broke. Your financial future depends on understanding the rules of the game before the game plays you.